Thank you, everybody, for dialing in today, tuning in for this update to the Q2 results from the NCREIF ODCE Index that myself, Phil Tiley, I head up our kind of performance and valuation data analytics at ODCE, and Robbie Tangen, who heads up the kind of advisory side of ODCE globally, will be taking you through the latest results on the ODCE to Q2. That's based on all 25 of the ODCE funds, and we include in that metrics from our own valuation data set to provide added intelligence and insight into the analysis. So we're delighted everyone could dial in today, and thanks for sparing your time. The webinar is kind of partly there as an overview of the themes in the market for our wider network of clients. It's also partly there as a precursor to our kind of one-to-one conversations we have with individual clients who are NCREIF members, where we kind of replicate this analysis on a comparative basis. We obviously look forward to those in the coming weeks, and we'll be extending some of that out, and we'll touch on that as we get into the analysis. Before pass over to Robbie, just a thanks to everybody that's been involved in this process of pulling the information together, because it is a big collective exercise internally within ODCE. Obviously, thanks to our clients for giving us privileged access to their data, and thanks for NCREIF for sharing, providing us the benchmark numbers at the performance levels that we start off with. So as normal, we could have, let's finish off, well, start where we finished off last quarter with the first recap on the polling question. I just say, if you've got questions we go through, do put them in the chat. So this is where we finished off last quarter, he says, if you can move your slides on. So Robbie, do you want to pick up on that, and then we can get into the results for this quarter?
Yeah, so we always ask this question like every quarter, right? So last quarter we asked where's the total unleveraged property return to be in 2Q, in like basically negative 1.5% in 1Q 2023, right? So majority, 80%, kind of basically choose B, which is -2 to +1% on total return. I think the power of many correct this time, right, Phil? Like usually this kind of basically spread out, but this time the cluster is pretty correct, right? So
yeah. And maybe just chucking in a sporty analogy, since we are in the midst of the Olympics, I think we did give everyone a pretty generous target to aim at there. But yep, the majority of people had it there in the right bracket. So let's get to those results, confirming here that the ODCE kind of did close in the quarter, so very nearly kind of crossing that divide into positive territory, but with a negative 0.1% total returns for the quarter. So the market is still technically on a downward trajectory. That's the 7th consecutive quarter of negative returns, but it's marginal. The rate of decline is almost slowing there to a standstill. Just to confirm, within that there's income and appreciation, so there's certainly offset within that number there. And to further clarify, what we're reporting on here is the pure real estate part of the ODCE, so there's no leverage in that number, no cash. Looking at how the pure kind of real estate performance levels have played out. To provide some historical context, with, as before and previously, we take the series back kind of around the start of the pandemic. So going back kind of 4 years now, when the returns did turn negative at the onset of the pandemic, before it kind of embarked upon that kind of almost unprecedented growth period, which is certainly fueled by certain sectors, where returns reached record heights at the top end of the 6% range. You then have a kind of change in the interest rate environment, and that growth period has been effectively being reversed back out again. But returns, thankfully, kind of heading back in the right direction again, and so very nearly crossing the divide into positive territory. Let's move straight from there, breaking down the numbers and unpacking them into the income and appreciation side of the return. If you go to the kind of right-hand side of this chart, you have that income return in green, now all but balancing out the write down in values in Q2. So kind of a momentary period of calm after kind of a 4-year period, during which the performance profile of the market is kind of being pulled one way and the next. From an appreciation standpoint, so focusing on the red bars, we've been breaking this kind of recent cycle into 3 distinct periods. You have that write down at the onset of the pandemic, when values were then taken down by 2.5%. This is then followed by 7 consecutive quarters of growth, during which just shy of 23% has has been added to property values. The majority of those gains though have now been cancelled out, with 8 consecutive quarters of declining values, during which values have come down by just over 20%. We made a reference last quarter to how this compares with the GFC. That downturn lasted 9 quarters, during which values were down around 33%. Thankfully, values haven't dropped to those levels, but whether this downturn extends out to a 9th quarter remains to be seen. It does sort of look to be on trend to join to a close. That rate of reduction has been reducing quarter over quarter. What we're then able to provide within Altus is added insight into the makeup of that appreciation piece. By drawing on our valuation data set, we can determine how much the movement in values is a product of the pure economic fundamentals versus what might be termed the investor sentiment or capital markets side. Regular listeners will be fairly familiar with this drill. So first we take the red bar here, transpose it onto the red line on this next chart, and bifurcate that appreciation in what's termed the yield versus the cash flow effect. So the yield effect is how much the movement in value is being dictated by the change in kind of actual valuation yields, changes in discount rates, change in exit caps, the cash flow. The blue bar is the impact on values from the change in those forward projected cash flows that are effectively being priced by those yields. And this kind of whole kind of period of correction the market has been through recently has been characterized clearly by real estate continued being repriced in response to a kind of change in that interest rate environment and against a somewhat, let's call it, muted, uncertain economic backdrop. And that's certainly become maybe a little bit more certain recently. And that's really what we're seeing kind of playing out in these kind of yield and cash flow metrics. Let's think to the most recent quarter. Take the yield effect first. Yields are still pulling back on values, but as you can see here, just 0.9%, so less than in prior quarters. Robbie, I guess the market no doubt has more than one eye on the Fed, which is kind of yet to make any interest rate cuts, but lots of chatter out there about expected rate cuts in September. And with that yield effect easing off, do you get a sense of kind of optimism, that kind of period of repricing in terms of the yield adjustment maybe drawing to a close now?
Yeah, it definitely feels that way, Phil, right? So especially with industrial and apartment, not so much for office though, which I think is still facing significant headwind there, which we're going to discuss later on, right? So sure. I'm going to look at from 2 aspects, right? So as you indicated, interest rate side and then transaction side. From rate perspective, there's definitely still uncertainty in second quarter, right? So at the beginning of second quarter, the 10-year treasury were around like 4.3. It moved up to around like 4.4 at the end of the quarter, right? So, and we look at today, it's around 4, but it was like 3.8 a couple of days ago, right? So the positive, I think majority basically already expecting kind of lower rate going forward, right? So many projected kind of normalized 10-year around 3.5 to 4%, right? So it's not about will the Fed cut rate, it's about when, right? So I think that's kind of what the uncertainty is kind of going on in second quarter, right? So, and then we kind of look at it like, okay, from that rate, what is that then on the transaction front, or from a point of view? We start seeing the larger transactions start to come back right this year, right? So we saw that basically kind of Blackstone industrial deal in the beginning of the year, right? So, and then the Blackstone AIRC, right? So, and then the KKR Quarterra apartment. We saw recent news on Retail Opportunity Investment Corp deal. As of yesterday, we saw the Equity Residential buying 11 apartment, right? So we're seeing a transaction from both public and private. That may be an indication as well that we are kind of close to the bottom, right? So except for the office, right? So overall as well, this kind of further supported based on our recent kind of roadshow with our client and investor in US, Canada, and Europe, which generally have been much more positive, right? So there's definitely optimism building up for commercial real estate here.
Okay, thanks, Robert. And obviously that supports that kind of moderating in that kind of that yield component there, and potentially maybe more the uncertainty, I would say, looks to reside more on the kind of the blue, the cash flow side of the equation. I mean, the economy looked to be possibly heading for a soft landing, but maybe not given more recent news and the unsettling of the markets earlier this week. Cash flows for now have been pretty much holding their ground. If you look at the kind of recent kind of period of that downturn, and yes, they suffered a bit of more of a setback at the start of the year. They thankfully look to be kind of leveling back out again. But given that historically, when you look to the left-hand side of this chart, It's cash flows that really create value for real estate. For me, it's kind of that lack of upside in that metric that's kind of arguably holding back any increase in values, and it feels that's what really needs to change in order to values to move back in the ascendancy. So what do you get a sense, Robbie, is maybe holding that back for now?
Yeah, I kind of look at this three factor that's holding this back, right? I believe, right? So I think one, we talked about it before as well, the supply, right? So there's definitely a supply challenges in some of the market, not broadly, but in some of the market, in some property type, right? So the good thing is the new pipeline have slowed down significantly. As many of the deal, as we know, it's not going to pencil out in today's higher interest rate environment. Now you add on the potential to slow down, right? So we believe this much more kind of mostly near-term issue. Once this supply is being absorbed, we're going to start seeing kind of potential tailwind afterward, right? So a second part, I think is, as you mentioned, Phil, the economy, right? So potential soft landing, it could be increased hard landing kind of scenario as well. So it's definitely a lot of question how this will impact the fundamentals, especially in the rent and occupancy side, right? So I think so far, fundamental been holding up, but this economy uncertainty definitely can make it much more difficult to forecast, right? So, and you have a more taper growth projection then as well. The third part, I think, is inflation, right? So this have been impacting more on the expense side of the equation, right? So it's definitely have been moderating, right? So insurance seem to slow down the increases, but there's still uncertainty as well, right? So how about the labor? What happened if there's many state and municipality implement higher minimum wage, right? So is it structural changes with the inflation story? So there's definitely question on the inflation side as well, and potential basically impact the expense side, right? So all this uncertainty, I think that's holding back the cash flow. Of course, not all property kind of get created equal. This is where we're going to discuss more deep dive later on as well. Phil, before we go deeper dive though, a little bit told me that you're working on some cool tools here, Phil, to help our client with kind of the breakdown of cash flow and yield effect globally. I think it's being showcased in our annual conference, the Altus Connect 24, correct, Phil?
Yeah, sure. Yeah. I mean, and on that point, this is the slide I get the most requests for, or myself and my team get the most requests for after this webinar, asking if we can kind of replicate this for a client's own portfolio, and how that kind of profile of appreciation compares with against the benchmark. And that's both kind of, so that's what we're kind of building out kind of analysis platform to provide. So it enables funds, whether across our wider advisory network or across our wider kind of Argus software network, to compare movements in their values against a benchmark data set. So kind of the focus initiative is really kind of to provide the clients with that narrative on how much the values are moving versus a benchmark, pretty much following a lot of the flow of what we cover off in these webinars, going down to sector level and going down to CBSA level. So I've got a bit of a screenshot, I believe, on the next slide around those. So taking that kind of yield and cash flow element of appreciation, how that plays out within the benchmark, how it plays out for a portfolio, how much a portfolio differs in terms of valuation movements, bringing into the analysis attribution as well. So how much of that variance is structural, how much of that is property specific, and opening that to the wider set of our client base in terms of valuation movements. And as you say, Robbie, we'll be showcasing this at our Connect conference in September. I think my colleague is most probably going to drop the registration link into the chat there. So if you want to learn more about that, please do contact either myself, Robbie, or your kind of Altus client representative. But yeah, that's a lot of what's to come around improving this analysis and providing it back to clients. But let's get back to the detail for the most recent quarter and get into those variances then across the sectors. So here you've got the confirmation of those performance numbers, total return up top, just negative in Q2, and then look across the sector. So the points to note when you're looking over the sectors for Q2 is performance-wise, all sectors are really improving on their performance in the opening 3 months of the year. Returns have crossed that divide and turned positive in 3 of the 4 main sectors. That said, there's still negative appreciation in each of those return numbers. And third, down at the bottom there, that's the range of returns across the best to the worst sector, and that dispersion in returns across the sector has started to track down and narrow. In terms of the rank order, which we're color coding there in terms of whether the sectors finish north or south the Odyssey overall average, I mean, offices clearly remain the outlier, firmly rooted to the bottom of the stack. Pace of decline, though, hasn't slowed notably, minus 5.7 compared with minus 2.5. And that's part of the reason for there being less dispersion now across the sectors, that and the fact that if you look across the other three major food groups, there's less than 50 basis points separating those other three sectors. Retails, give it that sporty analogy, top of the podium, lead sector, and returns actually there turned positive last quarter. They're joined in positive territory by the apartments and the industrial, and very little to separate the two. So a bit of a photo finish there sees industrials just pipping the apartments at the post. Other, keeping with the sporting analogies, dropping a little bit further back down the peloton, their returns, as in the overall Odyssey, still negative with the quarter. But if you kind of chart all this, you can see just how tightly clustered returns are now. Very little separate the main sectors. Still a case of that green line, offices versus the rest. But even offices are in step in that kind of slightly improved performance trajectory. What this chart though really serves as a reminder is just how bifurcated the market has been, both in that kind of growth period, when obviously that was led by the kind of industrials, league of their own there, and throughout the most recent downturn when kind of offices, that green line, has been cast adrift from the rest. And you can see the effects of that better on this next chart. So we're taking a slightly different perspective. We've used this before to set out how each of the sectors contributes to the kind of build up of the overall Odyssey return. So quantifying how much of that upside was led by the industrials, the red bars, and how much of the recent downturn has been determined by those green bars, the office sector. The way to make sense of this is simple math. It's kind of addition and subtraction. So were it not for the inclusion of the industrials and you pass out the red bar, then that kind of return at the top end would have been around 3 as opposed to the upper 6% marker. And without the offices in the downturn, returns would have been around 1 to 2% better quarter over quarter. And those returns would actually have turned positive in the most recent quarter. What this really does, though, bring home is just how impactful any one sector can have on the performance profile of the Odyssey, and kind of weightings towards these sectors has been a determining factor for certain funds in terms of whether they're out or underperforming. It's not the sole reason, but it has been part of the reason why we've seen quite a spread in returns over the course of the last 4 years. But given that we're now seeing a little bit less dispersion in returns across the sectors, I kind of wanted to return to this chart that we've used before, which looks at how much the variance in returns across the Odyssey funds is down to their kind of allocation strategies across sectors versus the property specifics and how the properties are performing within the sectors. So just to explain, we assign an allocation and a selection score to interpret how each of the funds has performed against the Odyssey. The allocation score is kind of calculated based on the fund's weightings versus the average weightings within the Odyssey, if that's beneficial or not. And the selection is then how much the variance in return is down to how their properties are performing within the individual sectors. And at the kind of height of that dispersion in returns and the top end of the market around the back end of 2021, start of 22, that kind of the average variant was kind of 50% based on allocation. And as those spreads across the sectors has started to narrow, allocation, those orange bars, has become less of a differentiating factor now.
Phil, I think one question that I think a lot of people brought up before as well, right? So the spread of return seemed to have moderated as you kind of show the allocation is kind of more normalized, right? So, but the return between different funds within Odyssey is still a variances, right? So what factor to create this thing? Is it MSA, more geographical location, or is it property specific as well? Kind of curious, Phil.
Yeah, I mean, that blue bar does tell a story about the property specifics, and as far as returns, I mean, the macros across the markets the sectors do kind of level themselves out. Then we are now starting to see more property specifics come into play, vintages, lease terms, tenant covenants. But I think that allocation element, slightly confusing here, is possibly understated here, because you've also got, to your point, MSAs, you've got allocation strategies within the sectors, and so that part is actually embedded within the selection score, and that's going to detail we get into with clients on a one-to-one basis, and actually will be part of that analysis tool that I was mentioning a couple of slides ago. But good to point that piece out. But let's getting off piece a little bit, so let's get back on track. Unpack the appreciation or the return profile across the sectors. So we're here unpacking that appreciation, yield, and cash flow. First point to note across the sectors is that red line. The appreciation is still negative in all four sectors, but there's very little to choose now in that makeup of appreciation between the sectors, with the exception at the bottom left, the offices. So lots of variance in the interplay as you go back over the last cycles, but as trends have started to moderate, they're all kind of arriving at a similar setup in Q2, but the sectors having gone through very different journeys to get to where they are now. Retail's bottom right have just edged ahead of the other sectors, shade more cash flow upside there. Retail's definitely more in that recovery mode. They suffered more of that performance setback leading into and at the immediacy of the pandemic. Apartments and industrials have improved marginally cash flow wise on their results in the opening 3 months of this year. So cash flows where the apartments where those cash flows dropped back have started to edge back up again into the ascendancy, only just. And industrials, which kind of flatlined in Q1, have started to pick up a little bit more on those cash flow gains. But let's remind ourselves, if retails are kind of in recovery mode, then apartments, industrials are experiencing certainly more of a tempering down, dialing back some of that or leveling off some of that growth that they experienced in that kind of post-pandemic growth period. The other point to note from this chart is that yields are still having a negative impact on value, although the impact is certainly less impactful than in prior quarters, maybe with the exception of offices. And offices still a very different set of circumstances compared to the other sectors, remaining challenged from both a yield and a cash flow standpoint. So it's the one sector we have that dual negative pulling down values. Just to complete the set, let's go to the other sector, and I've separated that from that self-storage, which is the largest, over 50% of that other grouping. Again, a pretty uneventful quarter when you go to the right-hand side. Yes, yields continuing to move out, having a negative impact, but minimal adjustments and only a slight positive cash flow counterbalance. Let's get now into the real detail of those yield and the cash flow effects. So this is still sticking Q1 to Q2. Very little variant across the sectors, maybe with the exception of the offices, cast a little bit further adrift. Most of the variance of the sectors is being played out in that cash flow piece. So larger gains in terms of cash flows for the retails, up for industrials, net down for offices, and a minimal improvement there for apartments and other. But it's yields that have that kind of more widespread impact. That's what's still lowering values across the sector. And that's what's really done the damage quarter on quarter. If you take this chart, this is Q1, but you play that out over the last 2 years, the period of the entirety of the period of correction, it's the yields of the major protagonists. They're the ones that have lowered the values with a bit of additional downside on cash flow for the offices. The variance is still on the cash flow side, but the main offset is still on the pricing. So maybe Robbie, maybe take the next slide just to explain maybe where to the audience we are now in terms of those pure pricing levels.
Yeah, I think if you look at on this chart, right, the trend can basically continue from previous quarter, right? So we start seeing the continued leveling off of pricing for all property type except for office. Kind of in here as well, you kind of note all the pricing already higher than pre-pandemic level, right? So if we look at discount rate, exit cap rate, basically have stabilized for industrial, apartment, retail, and they also kind of tend to converge now as well, right? So office, on the other hand, is the one that continued to diverge and start seeing kind of the continued increase in pricing, especially in discount rate perspective. And that's kind of basically continue to reflect the uncertainty in this field, right? So, and then the risk associated with office space. So this sector is definitely still facing a significant headwind, right? So both on the fundamental side and capital market side, right? So the good thing as well on transaction front, as we kind of mentioned earlier, there's definitely seeing larger transaction coming back to the market, which kind of tends to support the private valuation as well, right? So we start seeing the number of bidder on industrial and apartment deal some of them more than 40, 50 bids, right? So, but they overall seem basically to level off. There's definitely still pocket of uncertainty, right? So it's not everything else created equal, right? So there's that pocket as well have been driving some of the negative return, right? So, but overall, we're definitely kind of close to the bottom there.
Yeah, and just as we're seeing a bit of leveling out there on pricing, it's been a pretty modest quarter when it comes to cash flow. I wouldn't say uneventful because there's still a mixed set of results that are playing out in terms of the cash flow element of appreciation. Those that are familiar with these webinars kind of will understand that we're relaying that cash flow effect to a series of 6 key valuation metrics. There's more obviously that impacts it than just that, but we're singling out 6 there, and this will be kind of following in that analytics platform that I kind of mentioned previously. The bars show the percentage change on those valuation metrics over the quarter. There's no perfect science to it. You can't add those up to get the cash flow effect, but the color coding gives you a sense of what's having a positive and negative impact on those cash flows. And most of the variance in those cash flows is playing out between these 2 metrics here. So improvements or not in terms of market rents being pegged back or not by the change in those forward projected rent growth rates. And that's the adjustment in those rent growth rates up top there. I've inserted down below a chart that tracks how those rent growth rates have adjusted and their levels running up to Q2. So we just sort of think through the variances across the sectors, starting there with retails up the top, seeing a more meaningful uptick in market rent, and crucially, their growth rates still just about in the ascendancy. You can see on the yellow line there how those growth rates for retails have been progressively stepping back up, where the other sectors have been trending the other way. And for apartments and industrials, they've been coming down from more elevated levels that they pushed up to during that kind of growth period. Industrials, still a little bit more market rent increase than the apartments, so more of a net positive trade-off with that rent growth reduction. Apartments, for all intents and purposes, pretty much at a standstill, as these kind of metrics are effectively cancelling one another out. Offices, where there's no improvement and actually a little bit of scaling back in terms of those market rents, they're feeling the full effect of that reduction in those growth rates. Add into the mix the fact that occupancy levels are down, whereas they're up in the other areas. And the other aspect that plays into that negative cash flow is being picked up in this metric here, which is the operating expense ratio, which is picking up a mix of kind of rental concessions and an increase in operating expenses. So this is the ratio of projected operating costs to projected revenue and how that ratio changes over the quarter. So a red bar means that cost to revenue carry is increasing, and that's eating into that cash flow piece for the offices. Also, you need to throw into mix that final bar, which is the capital cost ratio, and that's kind of picking up the requirement for further additional budgeted investment into these office assets. And you can see from the time series, if I can put that up, that has really ratcheted up over the course of the last year, eating into those forward projected cash flows.
Yeah, Phil, I think that in here, right, I think one interesting note, you kind of look at it, the contractual rent increases for industrial, right? So this kind of show the reflecting the roll from contract to market, right? I believe in aggregate contractual rent is approximately 30% below market. As the lead roll, we start seeing the benefit of it. So that's why you start seeing the contractual revenue increase more than inflation and more than the other property type as well, Phil.
Sure. Yeah. And obviously that can further plays into that positive cash flow piece. But yeah, definitely worth flagging that one up. Thanks, Robbie. Just before we wrap up on the sectors, and we'll get into the detail of them, this looks at the percentage change in properties within each of those sectors value weighted. So just to explain, the green bar is the proportion of property values that are now increasing. The yellow is what proportion are at a standstill. The red, what proportion is still being lowered. With apartments, industrial, and retail, almost feel like we've reached a bit of an impasse there. There's many properties either rising in value or at a standstill versus those that continue to be written down. So that may suggest, and going back to that property-specific conversation we had, Robbie, that it's starting to become more about property specifics within those sectors more so than the wider macro or fiscal factors. Offices, though, different kettle of fish, still mainly in the red zone when you look at the most recent quarter. So evidence of the ongoing challenges that's facing that sector as a whole. And I know we've got a polling question, so maybe just to tee that up, this then just tells the audience how much those values have come down over the current period of correction, so down 20% overall, and the purple is how much those values then had changed versus where we were before we were hit with COVID. So office values down 40%, all of that in the most recent current period of correction. Retail values down by 10, but 20% when you build in the longer history. Apartment values in the current period of correction down 20, but they're pretty much on par with where they were when you build in that prior growth period. So, Robbie, do you want to pick up on this and take the next kind of polling question to tee off that?
Sounds good. Yeah, the first polling question, right? So when will the value decline reach the bottom, right? So basically, whether it's year-end 2024, first half 2025, second half 2025, or 2026 and beyond, right? So again, we'll give like maybe like 30 to 60 seconds, right? So Phil, what is your pick here, Phil? You're the optimism or you're the basically pessimist?
If I'm just following the pure numbers and the trajectory, then I most probably would hope that we might tip into that positive zone in A. But if the overall economic outlook gets a little bit more unsettled and things stall in those other sectors, and clearly there's further right down on the offices, we might be edging into B.
Yeah. I'm the same, right? So I think somewhere between A and B, right? So more optimistic, hopefully by year end, right? So, but it is kind of the office still a challenge there, right? So let's see the result. Oh, majorities pick year end 2024, like so 46%, and then the second is first half 2025. So it's kind of pretty similar to where we think it is, Phil. So quite interesting, relatively optimistic, I would say.
Interesting to see how that plays out, and we'll carry those conversations on with our clients over the weeks ahead, no doubt. So let's get into, and thanks everyone for pressing the buttons there. Let's get into the detail kind of within the sectors. So kind of back to this is now back to overall total return levels. See how they've shaken out quarter over quarter across the major metropolitan markets. We're ordered here west to east. When we get into the attribution, this is the kind of bifurcation of the market we start to provide. We'll get into the detail of each of the sectors, but just to navigate you around what we're looking at here. Top chart, returns for Q2. Everything's color coded relative to that overall Odyssey return of minus 0.1%. So green's what's accretive, or red, not to the overall Odyssey return. Table below is exactly the same setup, but for Q1. And then the bottom table is the difference between the Q1 and the Q2 return. And the majority of those are kind of in green, as the majority of markets have improved on their standing in the opening 3 months of the year. Not obviously not without exception. If you just focus between the Q2 and the Q1 tables, and just maybe first off look at the apartments and the industrials, there appears to be a little bit more green than red on the cards. So most markets are accretive now to the overall Odyssey return, and most markets, if you ignore the color coding, positive returns in positive return territory. Whereas for the offices, just as we saw in Q1, swathes of red for both those. So kind of challenges still pretty widespread, returns all negative, ranging from was that -1 to around about -4% this quarter. Retail's mixed set of results. So while this was the lead sector with that positive return and lead return overall, the reds on the card here do serve as a reminder that this sector maybe is not out of the woods just yet. It may be more localized and property-specific challenges out there that are coming through in these numbers. But let's kind of pick into the detail of each of the sectors. So just explain that, navigate yourself around this chart. So looking there at the last 4 quarters at the top, we've then got the 2-year annualized set of performance numbers. So that's a current period of correction. And then we're taking the results back to pre-COVID there with the 4-year annualized number. We've also confused things. We've mixed up the color coding here. So everything is color coded, whether it's north or south of those individual sector averages. Main trends that are coming really out of this slide, and it's pretty similar to how we narrated things last quarter, is so we had that kind of power shift from kind of the gateway to the Sunbelt markets that really took hold at the onset of the pandemic, and that's kind of playing out there in those red and green returns on those 4-year numbers. But then you go to the 2-year numbers, and a fair amount of that is now starting to unwind. So markets like Phoenix and into that other grouping, where there's a fair amount of Sunbelt spots, maybe having overextended themselves, now starting to be dialed back, maybe an element of oversupply creeping in there. Look at the most recent quarter also. You've got kind of Atlanta popping up there into the mix with a larger performance setback. Compare that with some of those gateway markets, which are now starting to show a little bit more resilience. Still negative, but holding out slightly better than the rest over the last couple of years. And then the other theme is that East-West theme. We mentioned it before, trailing West Coast markets and increasingly so quarter over quarter. So Robbie, any thoughts on those trends and observations there?
Yeah, the East-West, the bifurcation still exists, right? So we've seen that the past several quarters. So you can see in this chart, there's more red overall on this heat map, first on the left, right? So more green on the right, right? So kind of East-West, right? There's one thing as well, as you kind of indicated earlier, Phil, is gateway improvement, right? So if you look at New York City, the DC, the Boston, Chicago, there's kind of a spot of green there, right? So there's definitely, you can see improvement on the gateway market. That basically compared to the non-gateway market, right? So Atlanta, you can see that's kind of seeing the weakness, right? So that's the one that seeing a decline in occupancy. The second quarter kind of market reported around 91%. There's new construction delivery remain high, right? So granted though, the new construction pipeline are declining faster, but generally that supply issue is kind of putting a near-term pressure on the rent. That's why causing it to be more negative, I would say, in the second quarter, right? So Phoenix kind of take a pause after 7-quarter decline, right? So vacancy and asking rent seems to stabilize there, right? So on the positive side, you look at the Houston, which have a 2% kind of total return perspective. Vacancy have improved slightly from previous quarter. Definitely that market kind of showing strong absorption, showing kind of increase in rent, right? So that's why we're seeing the strong performer there.
Yeah, and I think the other positive really, if you look at that Q2 line, is the vast majority of those markets now in positive return territory. And if you take that Q2 and you kind of break it down into the yield and the cash flow side of the appreciation, I put on the right-hand side the Q1 numbers to compare against. The variance I really wanted to highlight here was where in Q1, those cash flows are being pretty much scaled back across the board. On the left-hand side of the Q2, the majority of those cash flows are now back in the ascendancy. Yes, the variant does kind of pick out the top to the bottom end of the order. If you take that kind of cash flow effect and then you kind of open it up for Q2, what you're seeing there is the kind of market rents in the main continuing to improve, balancing out, further scaling back of those growth rates, but that scaling back of growth rates is now pretty minor. So you do have the majority of those markets tipping into the positive cash flow effect. And the other encouraging point to note is this operating expense ratio, that cost to revenue carry is now trending down. Those folks that keep a back look at these slides like I do, if you can remember, this is what we showed for Q1. So that operating expense ratio was tilting out in Q1, and that's where we're picking up that increase in operating expense. We felt like that was, with the new budgets, that was a one-time hit on those cash flows, and thankfully we seem to have flushed that through. Cash flows are now generally back in the ascendancy. Yes, there's still some negative. Yes, there are markets where market rents, where maybe some supply issues are still being dialed back, but the vast majority of markets, those cash flows are in the ascendancy. So Robbie, I guess evidence of the kind of general health you might associated with this sector, your general thoughts around the overall positioning for apartments?
Yeah, I think on macro level, definitely agree there, Phil, right? So I think we're kind of close to the bottom for the apartment sector. The US multifamily vacancy, I think that reported to decline in 2Q, right, with strong absorption. And I believe there was a first decline in vacancy since mid-2021, right? So part of it due to the strong job market, right? So which is, again, I think job market question is the one that's being questioned today, right? So with potential economy slowdown, but overall, it's kind of fundamental, pretty strong and expected better than, it's kind of performing better than people projected, right? So then you look at the transaction front, we start seeing kind of higher volume than previous quarter, and which also further support, we kind of close to the bottom, right? So as you mentioned previously, that's the AIRC deal, right? So, and then the KKR Quatera deal, and then the yesterday announcement from Equity Residential, right? So, and then discussion with market participants as well, that investors are generally positive for this sector, especially with the declining new construction, right? So, and we expect basically a lot of the investors expecting higher than inflationary growth kind of 2-3 years out from now. So it's definitely positive sector, Phil.
Okay, good. Thanks for those additional thoughts. So let's pivot across to the industrial sector then. Let's just move my laptop on. Okay. Color coding aside here, it's just worth again noting Q2, most of those returns are now in positive territory. It's not without exception. Some markets, Southern California in particular, still being dialed back. Strengthening markets, ones that are really coming into their own, Miami, Atlanta, DC. You can throw Dallas into the mix again as well this quarter. Also worth noting that New York, given its size, is starting to hold its own once again. There's definitely variations here in terms of the markets, I guess, Robbie, in terms of where they are in their cycle, markets that maybe overextended themselves in the growth period versus those that are now seeing some steady upside. We did single out 4 here, so I don't know if you want to talk to those, any of those 4, or just general observations that we're seeing now playing out.
Yeah, it's very similar story to last quarter, right? So I think the weakness in LA and Inland Empire and stronger in Sun Belt. LA and Inland Empire kind of basically to the weakening cash flow due to kind of near-term supply issue, right? So we talked about supply issue previously as well. So that's why you see like lowering market rent, kind of like a lowering market rent growth. You look at vacancy in 2Q, kind of basically, again, and we don't have the chart IE, but they tend to be similar to LA, right? So if you look at vacancy in Inland Empire, it's about 7% versus LA, kind of about over 4% now. In the peak of the market, this 2 market is like sub 1%, sub 2-3% vacancy, right? So the positive side, the port volumes can basically continue to increase year over year. Consumer spending are still strong, which will boost the demand side of the equation. So we kind of feel it's more near-term kind of issue on the LA and Inland Empire, right? So New York, in comparison, you're seeing kind of the resurgence of big box leasing, right? So there's still new supply issue near term, right? So but there's leasing picking up on the better assets. So what we notice is a lot of the Class A product is holding up better, which is what a lot of majority of ODCE fund have, right? So Dallas reported the highest return this quarter at 2.7% total return, right? So if you look at that, the market's also reporting the strongest kind of quarterly net absorption on record here, right? So mostly also again due to the large tenant movement, right? So and vacancy and drop in that market as well. Miami, that's strong. They've been strong for a while now, right? So and vacancy is up slightly to the new supply, but it's still a sub 5% market. And rent continue to move upward and is expected to continue in the near future as well for the Miami. So overall, Phil, I think that the industrial look pretty positive, right? So economy is growing relatively, right? So it's potential slowdown, but it's still growing. We're still buying stuff, right? So export, import still up, right? So this kind of supporting the industrial market and investors as well, still bullish for this sector.
Yeah, and I mean, I guess on that point, when you look at the Q1 numbers and you break those down to yield versus cash flow effect, the vast majority of those markets are still seeing are now seeing that kind of further uptick in those cash flows. Those market rents are continuing to progress forward, and while those rent growth rates are still coming down in most markets, there's still that net positive interplay there in most of those, with the exception of, say, those Southern California markets that got maybe a little bit overextended, and those market rents are still now coming down. And so positive cash flow effects, and also just on the appreciation side, encouraging to see a number of those kind of markets moving into positive appreciation for the course. So if you say, Robbie, kind of a pretty healthy set of numbers as we get through Q2 for the industrial sector. Let's take the flip of that and then maybe look at the office side of the market. So first point to note here on that Q2, negative rates of return still across the board. If you look at the 2-year average, it's the usual suspects that differentiate the order. So on the downside, it's Seattle, San Francisco, Chicago, DC, New York over this current period of correction. Less downside associated with some of those more Sunbelt spots, like Dallas, Houston, Miami, also into that other grouping there on the right-hand side. So markets that typically have greater utilization of the office space. This quarter, larger setbacks, Seattle, San Francisco, LA, DC, also seeing a bit of a knock there in terms of that Miami return. So evidence maybe that challenges, there's some property specific challenges that can crop up in any market, and so no geography is protected from any property specific factors. But if you break down the Q1 and the Q2 net results into their yield versus cash flow metrics, then similar sets of results for both Q1 and Q2. Further cutback in cash flows, further movement out in yields. So you've got that double negative impacting on values in all sectors, both in Q1 and in Q2. Robbie, so is that kind of in thinking with your kind of pickup in conversations around the office sector?
Yeah, it is another negative quarter, right?
Yeah.
So the challenge are broad-based, even though you can look at the chart here, Sunbelt appear to outperform the gateway market. Still significant headwind though. I'm pretty sure everybody's getting sick of office discussion. Seemed like a Groundhog Day, right? So it repeat every single quarter, right? So not a gloomy day, no end really in sight yet. So although we start hearing some positive news on the leasing side, right? So typically on the better Class A plus asset, like with higher TI, right? So, but overall, still like a negative absorption in the office sector. Tenants are still trying to figure out, like, so what worked? Like, how does the hybrid model work? What's needed, right? So, back to the office is still very inconsistent, right? So, and I think the good part, we start seeing bifurcation, right? So what I mean is the best product, right? The Class A plus, like, is generally performing better, like in terms of leasing front as well. And then the older product, basically, it tend to struggle and might be obsolete and would require significant investment. And you get the middle of the pack trying to figure out where they will end up, right? So I think this is similar to the mall story that happened kind of previously, right? So the middle trying to figure out whether they're going to be survival or they're going to be the obsolete one, right? So, and yeah, so how do we break down the bifurcation is tricky. So I think that's why we're using this kind of occupancy and WALT breakdown, Phil. So I think it's what you're going to discuss shortly, right?
Yeah. So that's where we've taken the analysis to now. So when having these conversations back with our clients on a comparative basis, we're starting to break the market down into, for the traditional low, medium, and high. We're also breaking out there the life science and MOB because they are embedded in those numbers that NCREIF is still passing across. The difference between the low, medium, high, as you say, Robbie, is bracketed based on occupancy and lease term, and for those shorter lease durations, if they're identified in being in some of the more challenged markets. In terms of the weightings, about a 35% weighting there in high risk, shade less than 40% weighting in the medium risk, 10% kind of low risk, and just over 10% in the life science and MOB. And there's a clear, on the right-hand side, step relationship there in terms of the appreciation of the value declines over the last 3 years. At the bottom end, those high-risk property, high-risk properties have lost about half of their value. And if you then break that down into the different CBSA markets, you can see those high-risk groupings: New York, San Francisco, Portland, Seattle, DC, Chicago, here losing more than 50% of their values. But also, you break it across all these stratas, and the vast majority of the groupings have lost over 30% of their value over the course of the last 3 years. So kind of challenges have clearly been pretty stark and apparent there. Robbie, any surprises here in terms of the shake-up that we're seeing? Does it continue to get any worse? I guess a lot of people will be thinking.
It's just some high popping losses, right? It's massive
Yeah.
decline. Who would have thought this kind of decline in office before pandemic, right? So,
Yeah.
and what kind of interesting is like more and more bar, there's more than 50%, right? So I think 2 quarters ago, there's no bar that more than 50%. Last quarter, there were 4, and now there's 6, right? So there's
Yeah.
high risk New York and San Francisco lead the pack as well. And the one thing interesting, if you look at the middle side, like general office, have declined more than 40%, right? So I think that question as well today is just coming in, like, so how many of that differences variation of office return due to location or MSA? Look at this bar, you can kind of see the differences, right? So you own a lot of New York high risk asset versus you own basically more than Miami. You might not meet in Miami. There's going to be differences on the return on the fund level as well, due to what they own within the office sector, within one MSA, right? So I think the biggest question is like, will it get worse, right? So I think there's going to be, like I said, there's still headwind out there, right? So the question is, what will be the magnitude, right? So as many of the category have declined more than 50%, right? So how much more down when you're already down that much, right? So, and also with less weighting, right? So in different category, like, so even they come down more, how much is that going to impact the overall return, or even impact basically on the office return? So it's going to be the other thing as well, Phil, if we talk about, that's going to be asset by asset specific, right? So because there's middle bucket trying to figure out where they end up. Are they going to move up the survival, or are they going to move up the obsolete as well? So that's definitely going to be interesting to see in the near term as well.
Sure. Thanks, Robbie, for that additional intel there. I'm sure we'll have plenty of those conversations with our clients in the weeks ahead. Let's just finish off with retail, just looking at the time there. We're almost up against the clock. So this is for the year. Pull back on values. It's all down to the pricing side. What's encouraging is those cash flows, those blue bars, and this is where we're breaking things by subcategory more so than geography, but those cash flows are generally in the ascendancy, pretty much with just the one exception. Those rent growth rates, unlike the other sectors, in the ascendancies, and market rents are also ticking up, opening up that spread between contract and market rent, which kind of hopefully bodes well for the sector. So just your gauge on the retail sector before we get into any Q&A there, Robbie.
Sure. I think the overall retail sales remain strong in the first half, right? So as you can see, the US Census data kind of showing the retail sales, excluding auto and gasoline, kind of grew about 3.6% year over year, right? So however, though, the spending is mostly bifurcated. There's more consumer dollar that kind of go toward the higher end, higher price and essential, right? So, and then the discretionary spending continue to struggle. That's all you see on this chart, Phil. That's going to be the bifurcation as well, right? So you can see that basically the super regional with a lot of the higher end one that's doing better. The neighborhood, which have got all grocery, they're doing better. On the other hand, the fashion and specialty center, there's much more discretionary that's declined by more, right? So I think that's going to be see what's playing out with the consumer spending front as well.
Okay. Thank you very much, Robbie. Okay, I think we are through everything. Just one last question to put back to those that have dialed in, and then we can maybe pick out any questions that have come through.
Sure. This is the last poll, right? So we ask this every quarter, trying to see what is the expected total unleveraged property return to be in basically this coming quarter, right? So note it, like, is it going to be greater than 1%, where appreciation is positive, greater than 0? Or is it B, 0 to 1%, appreciation is negative 1 to 0? Or is it negative 2 to 0, appreciation is negative 3 to negative 1? Or is it below 2%, appreciation is greater than 3, right? So again, I think that's trying to see whether people think third quarter, that's the bottom on appreciation, or is it the bottom on total return, or it's still going to be negative, right? So Phil, if you make a call, what is that? What do you think?
To be optimistic,
what do you think people will pick? How about that, Phil?
I think people will most probably pick into the A's and B's. If the market stutters again and continues to kind of just, if we have more of the same, you could be into C, but I suspect people will be picking somewhere between A and B.
Yeah. Oh, B. So 0 to 1%, right? So I think that's basically, again, negative appreciation 1 to 0. So a little bit better than second quarter, I guess. And then there's some that think more negative, right? So, but a little bit less on the kind of the greater one. So, but yeah, B and C.
One more quarter of declining values. So it's
Yep.
same as the GFC, but not to the same depth. Okay.
Yeah. So.
And that's that. But people will send these slides out so everybody can get a copy of them. So and there'll be recordings as well. So anything that comes through on the Q&A, and if we don't get through all of these, which I doubt we will because we've got 3 minutes,
Yep.
We'll also list out some of the main questions that came through for everybody to look back on.
So the first question, basically, I saw that basically an office side, Phil, the distribution on high risk, kind of medium risk and low risk, like so, and medical office and life science, like so. Have that changed quarter over quarter? Like, so how is that compare? Like, is more asset being basically being kind of increasing to the high risk?
Right. Okay. And we actually got asked this a fair amount last quarter when we went round and saw people. What we've looked at on this is if you look at the value weight and you think of the high risk grouping, it's 35% now. It was actually a shade higher if you go back a year ago. Now, part of that you've got to think of is what's being sold out of these portfolios. And also part of that, I think you made the point, Robbie, as well, it's the kind of proportion of what's happened to those values. They're the ones that have been scaled down the more. So that weighting has reduced, and actually properties have been sold out of that grouping. If you take that 35% on high risk though, and you compare it back to say just before the pandemic, the number I think was around about 20%. So, you know, with the drop off in occupancies that we've seen since the onset of the pandemic, that kind of group of high risk has gone from, you know, a fifth to over a third of the office sample, if you think of it that way.
Yeah, and then to add as well, right? So there's a lot of sales within the office sector as well. So like I think that from our client on Odyssey, we see 50 plus sales coming from some 3Q 2022, right? Yeah. So and about like out of 50 somethings, but like 44 of them are basically called like medium risk and high risk asset, right? So there's definitely a lot more. There's definitely a lot more asset within the medium risk and high risk as well that being kind of removed from that percentage, right? So. Second question is basically, I think we talked about industrial. The question is, what is the WALT and contract market spread for the industrial currently? I think that's we talked about it earlier. So the contract versus market is about 30%, and the WALT about 5.2 year. Yeah. So basically on Odyssey. Next question. I mean, I'm able to search it while you're kind of talking, Phil. There's a lot more question on hotels. Like so. I said, what is percentage of hotel in Odyssey and what's kind of movement? So on high level, the percentage of hotel are pretty minor within Odyssey, yeah. Like it's about like 0.2%. And then there have been positive return basically on hotel over the past year and even last quarter as well. And there's one question, I think you brought it up as well, Phil. They kind of say the current quarter of kind of 8% or 20% decline. How is that compared to, I think that you mentioned again GFC, and then I think the question's what does that kind of compare to the GFC, Phil?
Yeah, GFC was about a third, about 33%. So we have a 20% write down now versus I think we calculated 33% GFC. Yep. They were both 9 periods of value write down. So yeah, maybe 1 quarter to go, but that feels like we're not going to hit those levels. So yeah, and obviously the challenges there were broadly based on real estate. There's been obviously variations, and you think of what's happened through the on the more resilient sides of the market.
Yep. I think we're up to time, right, Phil?
Yeah, we are a little bit over. Thanks, Robbie. Thanks, everybody. I mean, I suspect there's other questions there. What we should most probably do, we'll go back through them and list them out, maybe circulate that to everybody that's dialed in. The deck will be sent out to everybody. There will be a recording as well to pass out amongst your friends and family that they haven't been able to dial in. Thank you, everybody, though, for dialing in today. We certainly appreciate everybody's interest in this analysis. Any feedback as well, we love to receive that as well, so we can improve and enhance and continue to develop out the way that we're analyzing this information. We are providing more comparative applications to drill into this data, certainly for those portfolios that we're just in working with on the advisory side. There'll be more about that at our Connect conference in September. But if we don't catch up with folks over the next few months, then we will be back for the next quarter, updating you with the Q3 numbers. And thanks for dialing in. Thanks, Robbie, for joining me there today.
Thanks, everyone.